We start our first technical session on restructuring. We have an eminent speaker, and he has been kind enough to give us time and has flown all the way from Mumbai. Mr. Pradeep Kapasi, he is a very senior counsel, a senior chartered accountant, and he is leading his firm Pradeep Kapasi and Company. Sir has been the past president of two eminent associations, the Bombay Chartered Accountants Society and the Chamber of Tax Consultants. He has authored several professional books on taxations, including taxation and accounting of shares and securities, search and survey, wills and successions. He has been a regular contributor to newspaper, journals, and across. And sir is very passionate about trekking and traveling. And through his initiative Prayas, he leads charitable efforts such as the Winter Warmth drives in tribal areas of Maharashtra. With these words, please join me in welcoming Mr. Pradeep Kapasi. May I request Indu Bhaiya, Mr. Indu Chhatra, to come forward and present a Torio and a memento to Mr. Pradeep Kapasi. May I now request Mr. Kapasi to enlighten us with his talks. Thank you.
Good morning to all of you. My dear friend Mohit, the organizers, ladies and gentlemen, and of course my seniors also. At the outset, I'm extremely sorry for being late, see. What happens is that, Kolkata attracts me so much. And I find everything which is happening in and around, it grabs me. And then, it's very difficult to, move out of that temptation. Just when I was about to leave around 9:45 or 10, see, there was one lady, who was singing ball songs, see, by playing Ektara. And it was so wonderful and engrossing that I said that, maybe you all may wait for 5 more minutes. So thank you so much. It was wonderful. Yeah, I thank Mohit and friends to have invited me, and I congratulate all of you, for having conceived a wonderful program. I believe that yes, that this is something which is the present day's practice. So all of you who are involved in this, would really gain a lot. That's the way I look at it is, because everywhere where you would see, there had been a time then there was construction, okay. Lot of new things used to happen, lot of new businesses used to happen. And now the present era, especially this decade, is all about reconstruction of what we have already constructed. You need to realign, you need to reposition, and ensure that, okay, in the process you gain values. And how do you make value additions? That's where, as professionals, we chip in. Or how do you ensure that there is no value erosion in the restructuring? Because a wrong step at some place, could result into serious value erosion. And one of the things which I would be dealing with is about the tax erosion. If there is a tax saving, I perceive it as a value addition. If there is a tax liability, then there is a serious erosion. And on top of that, you are burdened with the litigation which perhaps might ensure for long. All of you are aware that these days, see, every week, if not every day, Supreme Court comes out with a landmark decision on several of the things. So the law which we believed was settled, see, in respect of the reopening and reassessment. Okay, on Thursday in Rajiv Bansal's case, Supreme Court had an absolutely topsy-turvy understanding of what the high courts have been holding. And it was not the case of overruling one high court, it was overruling several high courts which had taken a consistent view, right from Allahabad to Bombay, that is that the notice which were issued during the period 1st April to 30th June 2021, if they were under the old law, then such reopening was not valid. But Now these days what happens is that Supreme Court has found out a new thing. One of the decisions which we would be discussing today would also be about some altogether different decision of the court in the context of amalgamation. So Supreme Court is very regularly now relying on Article 148, whether it is tax cases or another. And what is the whole idea is to repair the mistakes which are committed by the authorities, the administrators in their understanding of law, and they shoot what? Not thousands, not tens of thousands, but lakhs of notices. And these notices, see, which have been issued without, in blatant ignorance of the law, are sought to be regularized by the Supreme Court. So these are the things, so we need to be careful about what is the risk analysis, the cost benefit analysis of all that what we do. I had requested Mohit, to share with you that, today our job would be to discuss only the relevant issues, not to introduce you to the subject, because introducing you to the subject would be a separate matter altogether. And the idea is, and Mohit has agreed that yes, that we will discuss only the issues which are arising out of several concepts, and all of them, trust me, that they are important, and we will therefore do that. Secondly, that because, yes, I am late, I am aware of that, and I have already apologized for that. And in any case, the decorum demands that, I should be able to conclude by the time which is allotted to me, 5 minutes plus or minus. So therefore, what I would do is that I will take you to the issue. You might feel that, and there are more than 60 issues. So therefore, even if I take one issue at a time, you'll have to be with me. You'll have to be attending to what we are discussing, and trust me that it would be helpful to you. Lastly, see, I have also seen to that okay, not only me who has been asked to work, see, on this topic, and I've been working for it almost for a week. But I believe that you should also supplement my work. So I have prepared some 8 case studies, which would be your homework. And that, if any one of you, and each of them have wonderful idea about restructuring the present structure which you are having. But these case studies are something on which you will have to work a little. And then in the end, if any one of you have any issues out of that, then you may please write to me on my mailbox, and I'll surely respond to this. With this little introduction, this is the synopsis of the different subjects which we are going to discuss. And as I have said, we will be limiting ourselves to the important issues arising out of it. This continues the synopsis, and then each of these is an accepted, practiced, and many of them are preferred modes of reconstruction and reorganization. The first thing which we will be taking up is something which is the flavor of the month or flavor of the year, and which is there are hosts of issues which arise out of a restructuring which takes place on account of the Insolvency and Bankruptcy Code. You all are aware that in 2016 or thereabout, the government of India subsumed several enactments like SARFAESI, Insolvency, Presidency Insolvency Act, even Companies Act, and the Debt Recovery Tribunal. All these provisions largely have been subsumed under the Insolvency and Bankruptcy Code. We will refer to that as an IBC, under which the National Company Law Tribunal or the Appellate Tribunal is permitted to accept the restructuring, and in the process of restructuring grant several reliefs in respect of the debts which are payable by the company to variety of creditors. Now all these reliefs, they entail serious issues in Income Tax Act. Unfortunately, unlike its predecessor, under earlier, all this liquidation used to happen under Sikh Industrial Companies Act of 1986, which it is no more. Now that act also is redundant long back. So under that, the BIFR had the power to grant even reliefs under Income Tax Act. As against that, under IBC, there are not any powers which have been specifically vested under the tribunal. And in that way of the matter, each of the concession which is given, would happen that if it is not passing the test under the Income Tax Act, it may, instead of helping you, it might seriously damage the company. To give you one example, that if you go to the tribunal asking for a relief in payment of creditors, and the tribunal is kind to give you a humongous relief of say 100 crores of rupees, and they say that okay, instead of 150 crores you are now required to pay only 50 crores. Now when it comes to the matters of taxation, these 100 crores, if it is not otherwise tax free, then in that case there would be a serious liability which might be as good as the amount of relief. So it is here that we will have to understand, and there are several reliefs. Tribunals are all over, including Supreme Court and High Courts are liberal in granting relief if you have a prescription which ensures that yes, when you go to the tribunal under the IBC, you have a good possibility of restructuring and reviving the business. That is paramount. If you are unable to put a scheme which will not revive the business, then that is not the place. You will have to secure an alternate answer elsewhere. So what are these? We will rush through these. The first is sundry creditors of goods. Now, instead of being asked, when you were required to pay 100 rupees, and then the tribunal is kind to give you relief of 75 rupees. The question is, what would happen to this? So if you see that these sundry creditors for goods, so these creditors are contracted in the course of business. And for what? For purchase of goods. Now this purchase of goods, if it pertains to earlier year, then in almost all cases you would have claimed a deduction. Now in such cases, if there is a relief, the deduction which you had claimed was for 100 rupees, and now relief which you are claiming is 75 rupees. So what is the accounting process? The accounting process is you will write back 75 rupees. Now when you write back this 75 rupees, will it become an income or not? That is the $1,000,000 question. The question is answered by section 41(1), which provides that any amount which has been allowed as a deduction in computing the total income in the year or in the preceding years, then in such case, that amount would be on not being asked to pay, on obtaining relief either from creditors or from the tribunal, that would be something which would be liable to tax. So this is 41(1) is an answer for sundry creditors for goods. If you have claimed a deduction, then in such case, two parts you will have to keep in mind is whether it's goods, services, labor dues or interest, two parts, that there must be an expenditure, very important. There must have been claimed, equally important, and the most important is it should have been allowed as a deduction. If these three things merge together, then in that case 41(1) stands activated and you will have to pay tax on it. There is no option for this. But if it is for some reason not allowed by AO, or you have voluntarily disallowed by applying some provision, mainly section 43B, then in such cases that amount, even when it is relieved, when the relief is granted, you will not have to pay tax on that. So this is one thing which will carry home about the first four things, including the interest, which is if interest is payable to NBFC, financial institutions, banks, then that interest is not allowable unless you had paid. And if you have paid it in a different year, that would be allowed in a different year. This is a story wherein you have not paid, and that's why you are seeking a relief. So you have not paid and you had voluntarily disallowed, or AO had disallowed, there will be no damage. But in most of the cases there could be a trouble. Further, the next is important is advance against goods. Most of the businesses, including the professionals, we receive advances in the course of business. Now obviously, because at the time when we receive advances, there is no taxation because they are advances, the goods are not supplied, property in goods is not passing, then the services are not delivered. Now, in such cases, this is shown as an advances and it is a balance sheet item. When these advances, which are admittedly repayable to the persons who had given you the money, then in such case, if the tribunal is granting the relief, what should be the taxation of it? Here is surely a case that you have not accounted for it as an income, as an expenditure, you have not claimed deduction, neither you have been allowed a deduction. Now, in such cases, the Supreme Court in two landmark decisions, both reported in 222 ITR, one is Karamchand Thapar and the other one is TVS Iyengar and Sons Limited. The Supreme Court says that if at the outset, at the time of receipt itself, if the character of receipt was that it was received in the course of business, for performing the services to be rendered in the course of business, but because the services were not rendered, then in such cases it may still attain a character of income. Now, this is something very important. It's not something new which I am sharing with you, but most of us have the habit of overlooking this. So, all of us as professionals, if you have been following cash system of accounting, there is no issue about it. But at some day, even in cash system of accounting, when this money becomes not payable, when services are not renderable, then this would attain the character of income. And in this, whether it was allowed, not allowed, offered, not offered, all this is irrelevant. 43B does not apply. So it is here that one needs to be very careful, and it's regularly in manufacturing concerns, say we come across cases, even in IT services cases, there are huge advances which have not been, for which services are not returned, and tribunal is kind to waive the repayment of it. So it is here that this would become an income. And mind you, here what happens is, once an order is passed, then especially the Ind AS requires you to route this right back through the profit and loss account. And once you do so, in one out of the two cases which I said, the issue was that if you have on your own accounted and credited it, what face you have to say that it is not taxable? Unless it is a capital receipt, which it is not. So therefore, be careful about this. Deposits, deposits also, if it is received in the course of business, when you have received deposit, surely it is not an income item. But at some point of time, if it is business deposits, security deposits, which your clients have paid you, there could be a trouble similar to that of an advances. You need to be very careful about it. Cash credits, overdrafts, secured loans, unsecured loans, all these are serious issues. And most of the waivers are in respect of this. Tribunal doesn't need any motivation to write back and give you relief in respect of these loans. So they liberally give you reliefs, but the relief comes with a price tag, and that is a taxation. The law which has developed is like this, that traditionally the authorities were of the view that these loans which were written back were taxable either under 41(1), and later on in the last 15 years it became fashionable for the authorities to tax it under 28(4). This is how it is. When it went to the courts were consistent more or less that yes, that if it is write back of a loan, then it is 41(1) would not apply. 41(1) would not apply. But there was a serious division when it came to 28(4). I believe all of us are familiar with all these provisions. Therefore, and you will have to in any case pardon me, otherwise we will not be able to conclude this. So 28(4) is a provision which provides for benefit and perquisite and in the course of business. So the courts, some of the courts said, including Bombay High Court and Madras High Court, stated that this would be taxable. Under 28(4). Fortunately, the matter went to Supreme Court in that 2017's landmark judgment. The Mahindra and Mahindra Limited's case, the Supreme Court said that देखो बाबा इसमें 41(1) भी नहीं लगेगा and 28(4) cannot apply because the benefit is otherwise said to be in cash. and is not in kind, is not in kind. That's the way the court has read. Obviously, the government has always been a bad loser. So what it did was the next year it amended the law 28(4). And today the present law is that even if the benefit is received in cash, which in case of loans could be, then in that case 28(4) will now hit you. This is something which we have to keep in mind. In between, there are also decisions and important decisions, including Delhi High Court in Logitronics case. They have been taking a view that it's all right if you have taken a loan and if it is returned back, we will not tax you. But let us examine the purpose for which the loan was taken. And also let us examine the application of the loan, how you have utilized the loan. So in such cases, the courts, they then therefore developed the judge-made law. It's not there in the Income Tax Act. They developed the judge-made law, saying that if the loan was borrowed for the purpose of working capital or for the purposes of meeting certain expenses and not for capital assets, then in such case, either 41(1) would apply. They were not sure of 28(4), but 41(1) may apply. And therefore, they said that if it is a term loan, don't worry about it. If it is for acquisition of capital assets, don't worry about it. But if it is working capital, so that's where these cash credits, overdrafts, all of them also would chip in. So there is a division of understanding on this. But now the question is, in short and substance, is that post amendment of 28(4), the reasonable clarity is about, that 41(1) would apply only if I had ever claimed an expenditure and it was allowed to me as a deduction, not otherwise. But 28(4) now is a lurking doubt. My view is, in short, is as under, that in the year in which I receive an amount, unless, as I said, it was in the course of business as advances or deposits for conducting my business, the rest of the borrowings, secured loans, unsecured loans, overdraft, cash credits, its application is irrelevant. The character of a receipt determined in the year of receipt does not automatically change on it being waived by the tribunal. And if you agree with this is something, we'll go to Supreme Court not once but 10 times. But the correct understanding, as I understand as a student of the law, is that the character of a receipt, had it been of a capital nature, not of a revenue nature, not in the course of business, then in such a case, these loans, when they are relieved, you are relieved of the liability, they should be independent of 28(4). They should not create any difficulty. There is a related issue in this and this is 56(2)(10) issue, which is also something which is nagging everybody, all professionals, that it is possible that you with diligence may get out for 41(1). You may successfully, contest your case on 28(4), but would you then be hit by 56(2)(10)? Cutting it short is that my answer to this is that, this is 56(2)(10) applies only in case where a sum is received without consideration. In my case, when I receive a loan, there is a consideration moving. And what is that consideration? Is that I am required to pay interest, service those loans. And that is, according to me, is a good and valid consideration in law. And therefore, 56(2)(10) cannot apply. 56(2)(10)(a) clause I am talking about, the rest B and C are not relevant at all. A is talking about any sum received. And those of you who have ever had the chance to read that carefully, there is a material distinction between B and C on one side and A on other side. And what is that difference is that B and C provide ropes in for the taxes a property received for no consideration and the property which is received for inadequate consideration. As against that, in A, it is sum received without consideration. Even if there is a minor consideration moving and which is interest, then in that case, A cannot apply. So I would therefore hold that this would not be 56 to 10 has nothing to bite, 28 4 can trouble you so much, but if you agree with my view that the purpose of taking a loan is not relevant, and the second proposition is that in such case, my original character of the receipt would continue to retain the character. Third, if you like, see, you have to, cross-examine this with 194R. 194R now seeks to provide for TDS on provision of benefit or perquisite. Now, if you would read 194R carefully, it starts with that any provision of benefit or a perquisite, you have to provide something. The tribunal cannot provide you anything. It is not a benefit at all. So the question of applying 28(4) does not arise at all. A benefit or a perquisite is only a benefit or a perquisite when you give me something. Here, the lender does not give me anything. He is not providing. He has no choice. He is just programmed, forced to concede that, okay, sir, I would receive 20% or 25% of what is otherwise my legitimate dues. So please keep that in mind. The one more on this slide is issue against shares against liabilities. Now, in this case, see, unless you state that my liability is waived, then provisions could apply for taxation. But when I say that, I'll match you by issue of shares, there is surely a consideration moving. There is no relief. There is no rebate. So in such circumstances, see, none of these provisions, in my respectful opinion, should apply. What happens is that in most of the restructuring under IBC is that you need to show the person who is bidding for the enterprise. He has to show that how would he generate these funds to revive the business. Assuming that 10 crores are required, he would perhaps will have to demonstrate before the tribunal that मैं 5 crore लेके आऊँगा. The tribunal would say that, all right, but sir, you need 10 crores of rupees. Where would you bring 5 crores? So you would say that there are office premises and factory premises, I don't need them. Of this company, I will sell them. Now it is when you sell these premises, they are depreciated assets. The issues would come under section 50 and otherwise. There is no laundering of section 50 or other provisions. So therefore you will have to be careful about this, that this might also attract capital gains tax, and it could be as serious as section 50 short-term capital gains. So unabsorbed depreciation, unabsorbed losses, and section 79. Fortunately, if you bid in a manner whereby it is on a going concern basis, this IBC provides for 3 kinds of restructuring, and what we are presently discussing is on a going concern basis. When it is on a takeover basis by some other companies, we are not discussing because there are very little. The company would stand liquidated and all this discussion would pale into nothing, largely. Right? So we are talking about a going concern basis. There is a new concept which has been developed by IBC tribunals, which is known as a going concern on liquidation, in the course of liquidation, which is not arising out of IBC, but there is a famous decision in the case of Gujarat NRE COKE, in which the tribunal has accepted that both could be possible. Now, how it is achievable could be a subject matter of 2 days discussion, but please look into it, those of you who would like to seriously look into this. So coming back to this is that if you are on a going concern, the depreciation would remain with you. Whether the asset continues or not nowadays is not relevant. Whether the business continues or not also is not relevant. If there is an unabsorbed depreciation which is lawfully claimed and allowed to be carried forward, you are good over there. When it comes to unabsorbed losses of CHC, then there is good that here there is an amendment in Income Tax Act. Income Tax Act has amended that if there is a relief under IBC 2016, then in such case you will get subject to compliance of other conditions of Section 79. So try to see that when you put up a resolution plan, see today what happens is there is a serious mismatch. IBC has become a big business, okay, for professionals. So therefore there is on one side there are a set of professionals who are excellent professionals, but they concentrate only on IBC and not in income tax. So therefore there is a slip, a proverbial gap between the cup and the lip. So what they do is they fail to claim this benefit. In the resolution plan which is put up before them, they must specifically seek for relief. And the law of 79 requires that the tribunal must give a notice to Principal Chief Commissioner of Income Tax for the inviting his objection to grant of relief under Section 79. So please be careful when you are asked to advise the professionals or the company, seek proper relief in the resolution plan. And resolution plan at times runs into 40 pages. So you need to be reading it with microscope glass, Then IBC expenses, though there is no decision on that effect, in the course of amalgamation and demerger, there is a view which is prevailing independent of 35DD is that these expenses are allowable. These expenses are also substantial. It needs a sanction of the tribunal. You cannot claim whatever you wish to do so. So therefore, if it is sanctioned, I would take a view that it is a business expenditure. Any restructuring is a business expenditure and should be allowed as a deduction. MAT again, there is an amendment in MAT, but all this what we have discussed for which there is no amendment. The amendment in MAT is limited that ordinarily you are given the lower of the unabsorbed depreciation or the unabsorbed loss as a set-off, which is fair, which is there in the law. But the amendment says कि आपको दोनों का aggregate deduction मिलेगा, which is a very handsome deduction as far as MAT is concerned. So there is no amendment to that effect but for these. So you will have to fend for yourself that if you are advised to account right back through profit and loss account, and Ind AS in many cases say that you have to route it through profit and loss account, you have a MAT issue. The only solution which I could think of is that if you are a BAA company or BAB company and you are seeking to be taxed under the new regiment, then in that case, MAT should not be much of an issue. 194R is going to be a big issue, Now what's happening is there is a person who has been asked to waive his debts. He has been asked to receive 20% of 100% which he was to receive. And now 194R says that if you provide a benefit or a perquisite, so who is the provider? The lender is a provider. So he is burdened with a tax deduction liability. एक तो उसका 80 रुपया चला गया है, ऊपर से he will be asked to pay 10 more rupees by way of TDS. From where would he deduct? So what would happen is the person who is required to pay 20 rupees, he will deduct tax on his behalf and pay it to the treasury. So there is a misery all over, unwritten misery. And profession was very clear that to write backs, this does not apply, 194. Where is the question of it being a benefit or a perquisite? Unfortunately, this issue has been addressed by the CBDT in 2 circulars. In 2 circulars, the CBDT says that, look, we believe that waivers are benefit and perquisites. We believe that waivers are a benefit, but we are kind to you because the law provides for removal of difficulties. In the interest of removing difficulties, not providing difficulties, they say that if the waiver is by a bank or a financial institution or a public limited company or a NBFC, then in such case this 194R would not apply. But in all other cases, including creditors, goods and services, other dues, in all such cases 194R would apply. That is the stand of the Central Board of Direct Taxes. Nobody is going to agree with this. Okay. One more thing which I would just bring it to your attention is the circulars which I am referring to is noted here. One more thing I will be referring to you is there are two very important provisions in the IBC code, and read them very carefully whenever you are advising or when you are practicing this. One is section 30 and one is section 238 of IBC code. This provides that if you have claimed relief in the resolution plan placed before the tribunal, and the tribunal is not rejecting it and is approving otherwise the resolution plan, which is in large cases it is, with minor modifications that for GST relief you go to the authorities, we don't have the power to do so. Such other things, they are routine observations made by the tribunal while approving the plan. And if that is so, I would not give up, and then I will equate this resolution plan approved by the tribunal as an order of the BIFR under SICA of 1986. Under SICA of 1986, BIFR had specific powers to grant relief under any of the provisions of income tax, including extending the period of losses and the depreciation. So I would believe that when you have sought relief and the tribunal has not commented on it, then in such case it is little far-fetched. But what happens is those who are who are already sunk or are in the sinking ship, they need something to hang on. And this hanger could perhaps at some place could help you. So coming to buyback of shares is, the buyback of shares is, Mohit, you will have to tell me 15 minutes in advance, 15 minutes, so that wherever I am, you will have to be content with that. Yes, and these are the subjects which cannot simply be rushed aside. Okay, so buyback, the amendment is that the story so far was that in the case of buyback, two things used to happen. That in case when the company buys back the shares, the company would be paying BBT, that is buyback tax, under 115, right? That was one. The amount which you receive on buyback was exempt under 1034A, because it was therefore not taxable, because the company was paying tax. And that if there is a resulting transfer and loss, then 46A would continue to apply. This is the short and sweet of the law which was existing up to 31st March 2024. Now what is happening with effect from 1st October, that is 30th September, 2024. Now what happens is, in an absolutely turnaround case, they said that we understand that that there is a difficulty on paying taxes by the company. Few years back when they introduced BBT, they said that that this is the best possible route. Look at the way two-mouthed approach of the legislature. Everything is being done in the name of legislature, and those should be more worried. They should be more worried because everything is spun out in their names, but they are not concerned. CBDT puts all this in their mouth. So therefore, what happens is that now they are saying no BBT, we will not give you any. They are saying no exemption under 1034A, मैंने इसको tax लगाना है. And tax would be at different varied rates depending upon the tax structure of the shareholders, right? Okay, no. And the third is what they are saying is, I will treat the entire amount. I will treat the entire amount as what? As dividend. As a dim dividend, of course. It is not a dividend under Companies Act. But I'll treat the entire amount as a dividend. And therefore, I will tax you, depending on your slab rates, which could be as high as 39%. So this is criminal. No deduction for cost of acquisition. No deduction whatsoever. So this is 222, ladies and gentlemen, F of the Income Tax Act. So here, and what are the issues arising out of it? This. One more thing which they're saying is, we are not omitting or deleting section 46A. So therefore, the impact of that would be that in the year of buyback, there will be a loss. And that loss could be huge loss. That loss could be huge loss. In the memorandum explaining this, they make some kind of a funny noise saying that, it may be allowed in future years. Now, obviously, in the same year also, if I have something, what is your problem? As it is, you are inflicting losses in my hands. Let me allow at least I have some breathing oxygen, but that is not the government of India. So coming back to this is that, yes, so this is the sum and substance of amendments. I have explained to you that this is. And then, what are the issues which would be arising out of it? There is no amendment in 70 and 71. There is a liability to TDS in the hands of the company on payment of buyback consideration, which is at 10%, and that is now effective, activated since last 4 days. Okay, so what are the issues? And there are a number of issues. We'll rush through them. First of all, I do not agree with the board's view or the finance minister's view that losses can be set off only in subsequent years. That's the way they record it, or that is the color they would like to take. According to me, if I am losing something on buyback by application of 46A, there is a transfer. Make no mistake about it. If there is a transfer and I have not received any money, because everything is taxed as deemed dividend. So therefore, my consideration which is moving, that is a full value of consideration for section 48 is nil. And nil minus my cost of acquisition of shares, which could be 10 crores also. Mostly in case of promoters, it runs into hundreds of crores. So then in that case, this is the loss which I would be making, and this loss would be under the head capital gains. This could be short-term capital loss, this could be long-term capital loss. As I had repeatedly stated that, or once at least stated, that 70 and 71 are not amended. And if they are not amended, whatever the losses, they have to be set off against. If I have profit, if I have no profits, I'll carry it forward, and then I'll follow finance minister in that case. So this is as far as the first is concerned. Second is, if you would see, 1034A, 46A and 222F and the Companies Act, all of them use very different language. One is talking about the event of buyback. The other one is talking about the payment in consideration of a buyback. So the issue which arises in a foolish mind like me is that, what is the year of taxation? Is it the year in which the buyback has happened? Or is it the year in which the receipts have been, I have received the money? Then this issue would begin to start. Most of the companies who were in a great hurry to go for buyback have already announced the scheme, have effected the buyback. But some companies, I understand, have yet not been able to make the payment. Now, in such case, what would happen is, if the liability to tax is receipt based, then the new law 222F apply. But if the liability to tax is on the basis of the event of buyback, and if it has taken place before 30th September, then in such a case, there would be no dividend taxation. My view would be that, that payment is immaterial, event is important, and if event has taken place, the fact that, the liability has already arisen, the event of payment is nothing but, discharging a liability. It is not because of buyback, it is because of a liability which the company has undertaken to pay me the buyback money. That is what is being paid. If you like this view, this should be the better view. What is criminal is that I have bought shares for 100 rupees. On buyback, they are giving me 90 rupees. On buyback, they are giving me 90 rupees. Okay. So what has happened? I am out of pocket by 10 rupees. There is no indexation also. And what 222F says is, this entire 90 rupees would be taxed at 39% in my hands. What is this? Wow, are we some kind of a banana republic or what, say, we should not have such laws, you should be kind. That is what was Rule 40BB, which used to give me a handsome deduction on account of the value of shares which I had purchased, but of course on the basis of what the company had received. But there was some element of sense, which here it's purely nonsense. Okay, right. Then applicability, this 222F would apply only to buyback of shares. Buyback of shares. Shares are shares. Okay, and the securities are wider. Under Section 2F of the Security Controls Regulation Act, there are host of securities. So if there are buybacks of other securities, this at least would not apply. Yes, but it would perhaps apply also to buyback of preference shares also. So you need to be careful about it, right? Okay. Then non-Section 68 payments is Section 68 of the Companies Act, not Section 68 of the Income Tax Act. 40BB I have already discussed. Higher rate for non-companies. Normally it is believed that the companies pay taxes at a lower rate. I mean at a higher rate as compared to our lesser mortals, individuals and all that. But in this case what would happen? The company might pay 20%, 18%, 22%, 27% on an outset. But I as an individual would be inflicted with a liability of 39%. I am just bringing it to your attention. But there is one more advantage for company also, and that is Section 80M. If this is treated as a dividend, which it would be, then in that case, see, I will have the benefit of cascading dividend, 80M and all that. So please keep that in mind. So structure the whole transaction comprehensively. There is no change in the profit, definition of accumulated profits and the explanations. Whatever could be the significance of it, I did not have much energy to look into all this, but then you may please look into this also. There is no change whatsoever. This is one important issue which can arise where DTAA would apply. In case there is a buyback, in such cases, two important issues that would arise is, this is a famous AAR decision which says that, okay, a buyback is the case of a dividend. Even before the amendment it had said. Whether that's a correct decision or not, it's for all of us to discuss and understand. But whether if a buyback is not an income which is subjected to tax under DTAA in the country of resident of the investor, then in that case, could one take a stand that this buyback being, an exceptional method of taxing an income and which is not a dividend under the DTAA. DTAA considers dividend to be very different, and most of these definitions of 222 may not apply. And dividend, like Mauritius route and few other routes, see, they are not taxable in the country if there is grandfathering benefit of 2017 is possible. So kindly look into this. This is a subject by itself. Even before the government amended the law, Madras High Court in Cognizant Technologies case stated a buyback is a case of a dividend. So, and this is something, which provided the fodder to the government that agar dividend hai to let us tax it as dividend. So this is also you may keep it in mind. But my question here is that once I know that I am going to be hit by a bull if I walk on the street, why should I walk on the street itself? Is it not that, if I have an option, in case of a buyback, I have an option from the company, I might opt for it, I may not opt for it. And in 90 out of 100 cases, it is proved that not opting for buyback is otherwise a commercially good proposition. So, ये भी देखिए आप करके, don't opt for buyback and you don't have this 222F problem at all. Don't opt for it. And after the prices variate and the effect of buyback is neutralized, You unload your shares in the market, you will have capital gains only. No dividend taxation, you will get deduction for the cost of shares also. So therefore, though the companies have been, very aggressive in offering buyback up to 30th September, it is mainly for the promoters, not for others. What some of the promoters have done is, the companies have done is, in order that the promoters are not burdened with the tax payments, they have offered the shares, they have offered to buy back shares which otherwise could have been 100 rupees, they have offered it at 115 or 112 rupees, so that the promoters are compensated in cash, so their cash flow is not affected. But that's a best thing, in my view, best thing is the Supreme Court decisions delivered way back in the case of Narsimhan's case. Supreme Court says that when a buyback happens, that was a case of a reduction of capital, but similar to buyback. Buyback also is nothing but reduction of capital. So when a reduction happens, you need to compartmentalize the taxation in different parts, 3 parts rather. First, that what is paid out of accumulated profits, if the company had, and in most of the cases, yes, it would be, then in that case, that would be treated as dividend under 2 subsection 22. The other part, which is more than the cost price of the shares which you had incurred, that would be considered as capital gains. That is what was 46A and 220T was all about. Rather, 46A was kindness personified. 46A said that I will not tax you on any part of it as dividend. You pay only capital gains and go away with that. So that was good, but somehow, there has been a rethinking about it. And this is a very criminal way of collecting taxes out of the pocket of the persons who are not otherwise capable of paying. So now, and the third thing Narsimhan said is, in Supreme Court in that case said is, the rest of it is refund of capital. So if that is what is brought back, and I am very sure that in a short time this will come back, you can't continue with this kind of idiocy. Okay. The third amendment, third thing which we are, all of these are different structures which we believe are important presently, because most of you know many things about corporatization, though we would be dealing with time permitting. All of us know also about amalgamation, demerger. Many of us know about slum cell also. These are practice models of restructuring. And I have listed all of the issues which arise out of this, but these are new things. Now, gift by a company. The amendment of 2024, it says 4713. 4713 used to provide that any gift, okay, whether under a will or inheritance or to a irrevocable trust or any gift, was something which was not to be construed as a transfer. So period. So whenever there are issues in family settlement, then when there were issues in corporate gifts, and there were huge issues. So the companies used to take shelter under 4713. Some days back, some years back, they said that, if you gift ESOP, I will not grant you exemption under 4713. ESOP, if it is gifted, it would be a transfer. Fair enough, because if you are moving out of the salary taxation to at least capital gains taxation, the government of India did not have much heartburn. But now the amendment says that any gift, other than by a person who is an individual or HUF, is a case of a transfer, or at least it is not a case of no transfer. At least it is case of a no transfer. In effect, what it means is that it would now be not possible for you to take a shelter under 47.3 for corporate gifts, that is gifts by corporates, companies or partnerships, LLPs, any other person other than individual or HUF. And the second is that, you would not be able to take shelter even in the context of a family settlement. wherein there is rearrangement of the holding of shares of the company amongst the members of the family. Now, in all such cases, there is bound to be an issue. Now, what is the thinking behind it is, please read all this carefully because this is going to be the flavor of the few years to come. The memorandum of this memorandum explaining the provisions which are amended is, it states that this is practiced or rather malpracticed, and therefore this is a practice which should be discouraged. And it's only when there is a gift by an individual or an HUF, it would be a case of no transfer, provided it is out of natural love and affection, or it is by way of a will or inheritance, or it is a settlement on an irrevocable trust. These are exemptions. Okay. But other than that, everything else is covered. Now, what is the intention? Now, ordinarily, as students of taxation and practitioners of taxation, serious practitioners, we understand that a gift can never result into an income unless it is a recipient-based taxation. We are not talking about a receipt-based taxation which is governed by what provision? 56 to 10. This is a case of a transferor which we are talking about. And it is the transferor who will have to take a stand, who was taking a stand so far under 47.3. That, sir, there is no transfer. Please don't trouble me. Don't come near me. But that is now not anymore possible. So what is the wisdom behind it is that they believe, the government of India, mighty government of India believes that on a transfer by way of a gift, there arises a liability to pay taxes. It seems that they had an option either to tax you on capital gains or to tax you under income from other sources. And somewhere somebody in the North Block thought that itna sab mat maro karke. So therefore they said that कि isko capital gains laga dete hain. So how would it work? That is what is something which we have to appreciate. This is the implication of the amendment as is explained in the memorandum is to hit you with the capital gains taxation. How would it be hit? By invoking 50C or 50CA or 50D. One of the provisions, all of these provisions are the provisions for, they are deeming fictions, no? They are deeming fictions. They assume what is the deemed value of full value of consideration. I'm sorry. Do not disturb पे है क्यों आता है WhatsApp perhaps आता है नहीं तो shut down कर दो ना. Sorry for that. Yeah. So what the intention is that if it is not covered by 47.3, you have to pay tax somewhere. So how do you pay these taxes? Let's understand. How do you pay these taxes? So first is that if I receive money, I have to compute capital gains, isn't it? Right? So what I have received? I have received, say, 1,00,000 rupees. I have received 1,00,000 rupees. Okay. 56 to 10 we will not see. But if I have given money to somebody, what we are right now examining is capital gains, is the gains in the hands of the transferor of a capital asset. So when you pay money out of my bank account, then in that case the cost of that money is also same, isn't it? 1,00,000 rupiah ka cost is also 1,00,000 rupees. So when you say that I have transferred 1,00,000 rupees, what would be deducted would be 1,00,000 rupees. So when you make a payment by check or cash or digital payments, I would believe that this new amendment should not trouble you at all. But if you were to transfer land and building as a gift, and here the benefit of transferring it to a relative is not available to the transferor. Make no mistakes about it. Read all this very carefully. Otherwise, we might hang our client somewhere. Okay. So here is a case wherein, if I transfer it even to my brother, then in that case, because and if I am a company, I am not an individual or an HUF, the benefit of relative does not apply to me. So then in that case 50C would be activated. And whatever is the Reddy-Rackner value or the Suckle value or the block value, that should be adopted. That's one. If the company transfers its shares, in many of the cases, shares held by it as investment. Most of the cases which I will just place before you are the cases wherein the companies holding shares have gifted it to either to the foreign companies or to the subsidiary companies or to companies left, right and center. What happens is that, when you abuse a law, then what the government hits back. And this is a classic case of serious abuse of law. When the law is abused on from all sides, these are the consequences. And now what would happen? Genuine cases like us would suffer because of that. But coming back to this, if I transfer shares of a closely held company, if it is a public limited company, 50 CA would not apply. But if it is closely held company, 50 CA would apply. That's one. If I transfer other assets which is governed by 50 CA or which is governed by the definition of property under 56(2), then there could be some difficulty over there. And lastly, that if the consideration which is moving is not determinable, the government clearly writes in that memorandum, then possibility of applying 50D should also be examined. Now 50D is a provision which says that when the value consideration is not determinable, then ऐसे सब चीज में fair market value लगा दो. But when consideration is not determinable, there cannot be a fair market value of it. What exactly is structured by that, I do not understand. But the idea is that now in all kinds of gifts by companies or LLPs, you must be ready to face the music under the new provision. Right. Of course, that in all cases, if you are out to tax me under the head capital gains, you will have to allow me a deduction of cost of acquisition. You will have to allow me the deduction of cost of acquisition. I am in a considered view of an opinion that this amendment would not hit the cases of pure genuine family settlement. For the reason that the law which has developed on family settlement is very clear that there is no gift in family settlement. You have an antecedent title in what you were receiving. And what happens in family settlement is that title is now perfected in your favor. So there is no gift, there is no transfer. And if there is no such thing, I will not seek benefit under section 47(3). So these are the list of cases. You may kindly look into these. These are the cases other than the two, that is other than one in Reddington, Madras High Court. Rest of the cases of the corporate company gifts are considered to be not taxable at all. But all of them without exception have said that the benefit is flowing under 47(3), which now is withdrawn in case of companies. And another thing which the courts have been saying is that the 47(3) benefit in any case was not available to deemed gifts. So please look into that. And deemed gifts or partial gifts there are so many structures which are in offing. What happens is you transfer something to somebody for 10 crores of rupees whose value is 20 crores of rupees. It was possible for the transferor to say that 10 crore is the consideration moving and 10 crores is the element of gift. 10 crores is the consideration moving, I am paying tax on it, and 10 crores is the gift on which no tax is payable. Now if you get ever into such structure which are lopsided structure and provide for some partial consideration, trust me, all these provisions, deeming fictions will start hitting you one after another. So be careful about it.
So just in the last slide,
Yes.
about trust. In the
Yeah.
last slide.
Previous one?
Yeah, previous.
Yeah, what is it?
Receipt by family.
Yes, where is that?
Taxation in the hands of Dhoni.
I should have told you. Okay. I'm sorry. Yes. Now, this was all about transferors taxation, not about the recipient's taxation. Recipient is whom? The person who receives, who is a transferee. In his case, there is no exemption from tax unless you fall under the pigeonholes which is exempting you. So, therefore, if you receive something from a relative, a company cannot have a relative. A company cannot have a relative, and therefore it is difficult. But if you are a trust, which is if you are a family trust, and that trust is for the sole benefit of a defendant, a company cannot have a dependent also. So therefore, in all such cases, what would happen is that, and again, that is the only trust created by, and it is for sole beneficiary. There are numerous issues around the exemption which is given in the exception under 56(2)(10), and that's what Mohit I was trying to put here, that receipt by a family trust would be exempt if there is a corporate settler who can establish that it is for a benefit of a dependent, which it would not be in a position to do so, and therefore there would be very little scope of getting out of this. The Dhonis would always be taxed. Please keep that in mind. Yeah. Slum sale, there are few very leading cases which had interpreted section 50B and section 2 subsection 40C to mean that slum sale would be considered as a slum sale and will be taxed under the head capital gains only when there was a pure sale. If it was a case of an exchange is a case wherein the transferee, instead of paying any consideration, is issuing shares of the transferee company. Then it was a case of an exchange. But as against that, if the transferee is paying cash for the purchase of the undertaking, then in that case, 50B would not apply. And we have few landmark cases which held, including the Bombay High Court, which held that in that case the deeming fiction of 50 capital B would not apply. And if it does not apply, perhaps there is no possibility of taxing the consideration on a slum price which you have received. So the government has amended the Act in 2021 to provide that any consideration or on sale or otherwise, so even if it is not a sale or if it is an exchange or any other manner, if there is a transfer, then in that case 50B would now apply. But now the important issue is that, and this is important, this is to be tested. It has been tested before the amendment, it will have to be retested afterwards. And the law before introduction of 50B in 2000 was that if there was a transfer of a business or an unit or an undertaking for a lump sum consideration, relying on B.C. Srinivasa Setty and Syndicate Bank's case, a case was made out that it is difficult to compute the capital gains. What I have transferred is business, and business has generated its value over number of years. There is no cost of acquisition which is defined. I do know what is the cost of fixed assets and my inventory and other things, but business ka cost is not determinable. And the courts were kind to hold that there is no taxation. Now 50B says, especially after amendment, would be the understanding of 50B would be that, and it comes with host of conditions, and then only it will be slum sale under section 2 subsection 42 capital C bracket over. So in such case it would be a slum sale. If it is not a slum sale, and one of the conditions is that that it requires you to transfer all assets and liabilities. That includes your patent, trademarks, brand equities and other things also. Tangible, intangible, licenses also. Now for some reason, if you could not transfer some of the assets, then in that case it would not be a compliant slum sale, and therefore I would take a view that 50 capital B would not apply. But what I have transferred is still a business. It may not be compliant with 50B. And if it is what I have transferred is a business, under what provision of law you will tax me? You will thereafter calculate itemized capital gains for which no specific consideration is moving to me. You will allot cost of acquisition in respect of each of the items. God knows. There is no provision for doing so. So therefore, in such circumstances, I would take a stand that it is in the interest of the government to say that no matter what, if once it is slum cell, 50B would apply. But it has not done so. This is important. Then the next is a simple case is that in some cases, in spite of having transferred your land and building under a slum sale, the purchaser has insisted that please ek deed of conveyance bana do land and building ka for revenue records, which is a common practice. Okay. Now in such cases, the department takes a view that in case of land and building, I will apply 50C. In case of building which is depreciated, which is a factory building, I will apply section 50. This is the decision, of Karnataka High Court says that aisa sab mat karo. You have no right to do so. This is a useful decision. You may use this. Next is very interesting. This was a case wherein, an undertaking was transferred. An undertaking was transferred for an amount of 143 crores. For an amount of 143 crores. The transfer he had undertaken to service the liabilities which far exceeded the assets which had acquired by an whooping amount of 170 crores. So the assessing officer said that, look, I'll tax you on 313 crores. And the assessee said that you cannot tax me on anything because there is no consideration moving. In fact, I have to pay for this. And the assessing officer said, sir, what you are paying is nothing but a consideration. You are not paying to the transferor, but you are paying to his creditors. And therefore, it should be consideration. Logically, under the Indian Contract Act, it makes sense that you are overtaking somebody's liability, undertaking somebody's liability. This matter in Zuari's case, that is Birla Group's case, the tribunal first said that, hey, this is nonsense, you can tax only on 143 crores. But then the department did not give up and it went to special bench in a different case, Summit Securities. And in this case, the special bench has taken a review some 15 years back, which law is not overruled by the High Court. So which is a valid law delivered by the special bench, which say that negative net worth would be added to the consideration which is moving or something which is paid to the transferor. So you have to be very careful on this. But next is an interesting thing. A slum sale happened. And simultaneously with this slum sale, one of the directors was paid a separate consideration for no compete. And the issue was that whether that should be tagged to the slum sale consideration or not. And fortunately, the Delhi tribunal said that that is a separate thing. It is a matter between promoters, directors and the company. And in non-compete money in those days was not taxable. So therefore, what I am trying to say that is if you as a promoter are in a position to transfer something and receive some side consideration, you should examine the possibility of it not being taxed. The next is that issue arises and quite often. When on one count I am saying it is a slum sale, so that I should be taxed under the head capital gains. Then I am going further, I am saying what I have done, slum sale is to my holding company or to my subsidiary company, and therefore 47(4) or 5 should apply. The courts are saying that 47(4) is a case of a transfer. Sure. 47(4) is a case of a transfer. And in that view of the matter, In a slum sale, it is a case of a sale as distinct from transfer. So in such cases, the benefit of 47(4) or 5 would not apply and the slum sale would be taxed. This is yet to be tested by the apex court, but there is both the views I have put before you. In a slum sale, if you transfer the depreciable asset, then in such case there would be no section 50 applicability. It doesn't read, see, it's brainstorming, that is the settled law. Then there is again an interesting issue like that on holding subsidiary transfer. Can you apply the benefit of 47(4) or 5 in case of amalgamation of holding company with subsidiary or vice versa? The courts are again saying no, that would not be possible. Amalgamation is through the process of court proceedings, while as against that, slum sale is the voluntary act between the two parties, and I concur with decisions. Then the next is that what should be the period of holding? This is settled by the Supreme Court. If the unit or an undertaking or the business, if it is more than 3 years old, then in that case it would be considered as long term, which according to me after the amendment now would be 2 years. Unfortunately, 50B is not amended. 50B is not amended, which shortly should be amended, where under the period of holding still is 3 years. So if you look into 2 subsection 42A, it is 2 years, but for the purposes of 50B, it is 3 years. So it is an anomaly which will have to be rectified. If you ever record in the slum sale deed itemized valuation and then come to the aggregate valuation, Supreme Court says in such case I will treat each of these as separate capital gains for each of the assets and accordingly tax you. Then 50 would apply, 50C would apply, many other provisions, 50CA would also apply. There is a view which is emerging is that, if by virtue of an order of a court, if a slum sale happens, then in that case 50B should not apply. According to me, after amendment of 2021, any mode of transfer of an undertaking under a slum sale, be that by the order of court or otherwise, would be covered by 50B. But there is a view which is prevailing. This is then Delhi High Court's decision. Last is an obnoxious decision. See, ordinarily, as chartered accountants, we are clear in our view that if an undertaking is acquired or a business is acquired or an unit is acquired for a handsome consideration, in a rational manner, the acquisition price has to be allocated over the cost of acquisition of separate assets which I have acquired. And based on that, the depreciation would be claimed. And this is otherwise not something which had been a case of dispute between the Government of India and the assessees or taxpayers. But this is the decision wherein in Dharampal's case, Delhi High Court has taken a view that it is succession or it is a pure case of succession. And because it is a case of pure succession, 49(1) would apply. And if 49(1) applies to such a case, then in such case, the cost of the previous owner for each of the assets which are recorded in your books would become your cost for the purposes of section 43(1) and also for the purposes of section 49. I don't concur with decision, but you will have to be concerned with decision, and I'll keep my fingers crossed. Now, Mehul, I have few choices. Mohit, I have few choices. I'll just take you to this. Yeah. See, I can take you to amalgamation, demerger, company to LLB, corporatization, part 21, firm to company, proprietary concern, firm to LLP, holding subsidiary holding, liquidation, dim dividend. Or there are 8 case studies which are differently structured. And if all of you are interested in understanding some new structures, then those are not case law based. Okay, so it's all of us feel so, right? And in any case, all other structures I have painstakingly put my views there, supported them with this, and you may please refer to them. If there is anything, write to me anytime, and I'll be too happy to answer that. Only it may take 2-3 days, but I'll surely respond. Okay. So we come to case studies. There's some good material. I'll take 5 minutes on something different. All of you as tax practitioners are aware about Part 9 of the Companies Act 1956. Right? Correct? So this was one of the accepted mode. When did you come? I didn't notice you. Hi, how are you? Good, na? Good, good, good. Okay, right. Yeah. Okay. So that part 9 is something which is an art which is perfected without paying taxes, at least in the field of capital gains. There are large issues relating to depreciation, losses and other things. But other than that, see, part 9 was a perfected design. And fortunately, 3 high courts have blessed the design also. So now, but under the Companies Act 2013, this part 9 has vanished because it was under 1956 Act. So that not much of the thinking has developed on chapter 21 of Companies Act 2013. If you read these provisions 366 to 374, our view is that it is to a large extent similar to what was part 9 of the Companies Act 1956. And therefore, in that view of the matter, what had been determined under part 9 should equivalently apply to chapter 21, only we need to try. And after a detailed consideration, we are clear that chapter 21 is a good way of getting out of 40. See, you still have, why this is now not a preferred option is that I have 4713, I have 4713B, I have 4714 also, right? And the fourth is I have a benefit of book value transfer also. So in all 4 cases, virtually no tax is payable. And therefore people opt for that. It is found to be attractive. But what happens is all of those cases, those options, they come with lots of terms and conditions, right? The standard tag is terms and conditions apply. And there in one case there are 7 conditions, in one there are 6 conditions. In book value there is no value addition. Okay, so therefore the synergies which I should acquire of transfer are not available to me. As against that, when I don't need to comply with conditions, if I go through this chapter 21, there's a good case, and I'll take 2 minutes. Registration and stamp duty, this Madras High Court and Andhra Pradesh High Court says it's not leviable. Okay. Section 45(1) is not applicable. All these high courts and the tribunals are confirming this without exception. 45(4), the erstwhile 45(4) would not apply. These are the cases. I would take a clue that even on that fixed 45(4), the new 45(4) is also a fiction. 9B is also a fiction, and therefore they should not apply to me. They should not apply to my cases. So if this is so, that the only thing which you need to be worried about, the unabsorbed depreciation and losses. You have this case of Amin Machinery of Ahmedabad Tribunal, which says that आपको ये unabsorbed carry forward नहीं मिलेगा. So that you will have to work well with that. Okay. And some of the cases like Unity Core and all, they have taken a view that आपको chapter 9 में भी, part 9 में भी exemption है, and even when you are otherwise complying with 4713, you can otherwise, so that is a second wall of defense. So this is it. So we further proceed. Yes. Now this is a case study in the context of 115 BAB. BAB is a provision which says that if you set up if you set up a new company which is engaged in the business of manufacturing, then in that case, you will be paying taxes at the rate of 15% plus surcharge plus EC, which is a very great handsome benefit. You pay taxes which is lesser than even the capital gains taxation at times. So therefore, the idea is that, okay, how do I fall into these? So is there a possibility? These are all different innovative structures. They are not tested, but they are something which are practiced in some corners in the profession. Some are recommended, some are practiced by our office. So therefore, you may not jump into this. This is something which you will have to apply your own mind. That's why I said that this is homework for you. This is homework for you, right? So coming to this is that consider a possibility of an existing company which has been 20 years old. Consider a possibility of an existing company with two undertakings or two different businesses. Demerge that company into two companies. One is resulting company, other one is demerged company. The resulting company would be a new company. The resulting company would be a new company which is set up after the prescribed date, but it will take over an old manufacturing unit. So what it would do is, it is a new company, but it continue to be a manufacturing unit. It continue to be. Now if you would carefully read this provision BAB, what is required is the company should be set up anew. Company should be set up anew. Now, and there are no conditions about the old baggage, that it is restructuring, split up, and all such things which are otherwise famously placed in all other provisions. So when there is no such condition, the only condition which I am required is that a new company is set up, and if resulting company is a new company, which I am considerably of an opinion that it is, then in that case, can you try and avail the benefit of BAB? If it is not given to you, in any case there is no loss at all. You would in any case pay the taxes which you were otherwise paying. So this is one thing you will have to, and I'll be happy if some of you reject these proposals, okay, and come out with something different. I'll be happy, and you can share your new structures also. Then the next is that that there is an issue that I want to convert my firm to LLP. I want to convert my firm to LLP. And in that case, what happens? This is a non-compliance. This is not complying with the conditions of all 4713. Now, in such case, can I take a stand that my conversion is a statutory conversion, and which is happening under Schedule 2 and 3 of the LLP Act of 2008. And in that view of the matter, when there is a statutory vesting, can I take a stand that yes, that I am deliberately structuring the transaction as if it is a structure which is not complying with 4713. So this is another thing I would believe that you can. The only caution which you can take is, please look into this Mumbai Tribunal's decision in the case of Celerity Power, LLP. In that case, the Celerity Power, the tribunal said, the decision is against the assessee. Celerity said that you have not complied with 4713, and therefore we will not grant you the exemption under 4713. It's a serious case. Yes, but in the end it said that, look, while we would like to tax you, we cannot tax you. And why we cannot tax you is because the transfer had taken place at book value in Celerity Power's case. So therefore there was no valid consideration moving. Now if that is acceptable to you, which is also the case of Aviva in the context of slum sale. So if such interesting things are acceptable to you, there is still, instead of going by 4713, see 4713 comes with a burden. there's a baggage that you will have to keep on complying with those conditions for next so many years, 3 years, 5 years. ये सब नहीं होता है. In the present day, there are restructuring, and within that there is yet another restructuring. So in such cases, if you are keen on statutory vesting, there is a case. Then company to LLP. I am a company. I want to convert myself into LLP, right? And I am a company with 2 units. I am a company with 2 units, and I have a difficulty, which is on account of clause EA of 4713, wherein the value of assets is more than 5 crores of rupees. Now in this case, if I demerge an unit before converting into LLP, then in that case, my values of the assets will come down to less than 5 crores of rupees. And if that is so, thereafter, the one which is not the resulting unit, but the demerged unit, if I convert it into LLP, I will have benefit of all the provisions of 4713B. That is the third structure. The fourth is the dividend distribution structure. This was actually attempted at a time, there was a dividend distribution tax, but I believe that this continues to be relevant today also. So this is a case of a company with share capital and substantial reserves. If it distributes dividend, 2 issues arise. One is that there is a dividend taxation now in the hands of the shareholder, and the other one is that that there is a FEMA remittance if it is to be paid to the foreign company or holding foreign company. Then in that case, there is a possibility that if I, as a foreign holding company or even as an Indian holding company, set up another subsidiary. This is a case of a 100% subsidiary. If I set up another subsidiary, 100% subsidiary, and thereafter transfer that unit from the first subsidiary company, Indian subsidiary company, to another subsidiary company, from and take the benefit of 47.4, then in that case the entire transaction of transfer would be exempt from tax, and therefore it would be outside the clutches of this. The only concern would be that how that money could be taken out by complying with the FEMA provisions. So the perhaps possible solution, none of this I am advising. These are I am not betting for this. This is not something whereby I am suggesting any tax avoidance or tax evasion. I am just putting structures which are lawful, and therefore in such cases where the assets are being transferred, with substantial reserves, then in such case, is there a possibility of issuing shares at a premium? If that is so, then in such cases, the foreign holding company or the Indian holding company would have enjoy the benefit of the reserves without paying dividend taxation. Then the next is merger of companies. There is one loss-making company, right? There is one loss-making company and the other one is a profit-making company. You are hit by section 79, you are hit by otherwise 72A. Now in case instead of merging the loss-making company into the profit-making company, this is something which is common. It's a case of a reverse merger. Now if you practice that, then in that case, see that there would not be any liability to tax. But that is not something which I am trying to test here. In this case study, which I am trying to test is whether GAR would apply or not. Whether GAR would apply in such kind of, if you apply provisions of Income Tax Act in isolation, independent of GAR, this is a perfectly orchestrated mechanism which should not have any difficulty. But after introduction of section 95 to 105 from 1/4/2017, you need to examine whether GAR is applicable or not. My office has come to an understanding that even if GAR is applicable, there is no tax impact on this. The benefit of tax is when you get into a structure which is considered to be a toxic structure by the GAR authorities, then in that case the benefit which is to be decided is the benefit in the present day. The benefit must be live, kicking and alive. It should be presently possible. And if it is less than 3 crores, GAR would not apply. But in a case where on account of absorption of the few losses in the future years, if I were to save some money, whether that could ever be considered as a tax benefit is something which is placed for your kind consideration. Do share your views on that. Reduction of capital. Now, this is a case wherein what happens is that instead of getting into amalgamation, demerger or any such other thing, I simply acquire the shares from the market or in an off-market transaction, the shares of another loss-making company. And thereafter the loss-making company goes for reduction of capital. It goes for reduction of capital which will result into losses in the case of the company which had acquired the shares. And in the process, see what would happen is you would have acquired the shares also, you would have acquired the company also and the controlling interest, and in the process perhaps you might have got the benefit of claiming huge losses also. Here there could be a difficulty of GAR also. Now these are the cases wherein there are transactions between associated enterprises and the transfer pricing provisions apply. Then in such case, what is thought about is that the Indian subsidiary company, instead of transferring something to the permanent establishment of the foreign holding company, to which the provisions of transfer pricing may apply, instead of that, if the Indian company or the foreign company were to set up an Indian LLP, which would then not be considered as an associated enterprise, or at least, even if it is so considered, provisions of transfer pricing would not apply to such a case. And this is the last one, is that when company is to be converted to LLP, there is compliance of clause F also, which is applicable. And that is a case wherein, if somebody takes a view that provisions of clause F would apply, and that there is some consideration moving in addition to other than shares. In such case, what is sought to be tested is that if bonus shares are issued prior to conversion, then in such case, would the provisions, would I be said to have continued to comply with the conditions. The idea is that if you have free reserves, which you are utilizing for, issuing bonus shares, then that 5 years embargo would not apply to you. So this is, friends, ladies and gentlemen, this is something, I thought of sharing with you. Once again, that I'm sorry that I have not been able to cover most of the things which I thought I would cover, but kindly go through that. If we have not covered today, some other day we would. Thank you so much. Thank you.
Friends, we can have few questions from the audience, if any. Yeah, Ayush.
So, that is something, I provided you with a simple analogy that interest itself is a consideration moving. The better and the greater consideration would be that a loan comes with a stipulation of repayment. That itself is a consideration. And you have settled position under 56(2), 6 and 7, where under the employees who were given the loan, in their hands, this government had wanted to tax it under 56(2). The courts laughed at them. So that would still continue to be valid. 56(2) ka, I don't think there should be a difficulty. Thank you.
Yeah. Any more questions? So in the last case on bonus shares, what you said that you can issue bonus shares prior to conversion.
Yes.
So once bonus shares are issued prior to conversion, they go into capital.
Yes.
Now when the company is converted to LLP, does it mean that to the extent of capital arising on bonus, that can be withdrawn as capital by the partners of the LP post conversion?
So, okay, very well, right. See, what would happen is that, by virtue of me holding bonus shares and the shares which I had subscribed, proportionate credit to my capital account would happen. There is a prohibition of withdrawing the reserves. There is a prohibition of indirectly withdrawing the reserves. You have this famous Calcutta decision in Aravali Polymers, which says that indirectly also if you have given interest-free loan to the partners who were erstwhile directors, there is a problem. But here is a case wherein it is my capital account itself, okay, on which there is no prohibition, there is no restriction, there is no limitation, there is no embargo. And in that view of the matter, if I were to transfer those shares to anybody else, I would take a view. Capital realignment is not an issue at all under 4730.
And so last on the celerity power, what you said that they said that computation is not possible because it is at book value. What happens in the hands of the shareholders?
Obviously, see, you can't keep the cake and eat it too also. Obviously, then in that case, in the books of the not in the books of the shareholders.
Because from company to LLP, they said it is at book value, so in the hands of company, there will be no tax. But the shareholders who are holding the shares, since it is a case of non-compliant conversion, what happens in that case? When that judgment did not deal upon that.
Very well, that judgment did not deal. It's a wonderful issue which you have raised, is that I am from 1998. And after this 2010 introduction of 13B, I am of a view that, there cannot be any taxation in the hands of the shareholders. Though the government has granted the benefit of exemption, but I would believe that it is a superfluous exemption. It's like Section 10 exemption, wherein they say that, this would not be taxed. Like 47(3), gift will not be taxed. But gift could not ever be taxed. An income and a receipt which is not an income. In this case, the shareholder has no role to play. Now, if what Mohit says, it is an interesting thing. If Mohit says that there is a need for exemption in the hands of the shareholder, that would mean that, in order for it to be logically concluded, my answers are threefold. Please hear me out properly. A, that would provisions of Section 50CA apply at all? 50CA requires that, I as a shareholder should have transferred something, not out of statutory vesting, but my own volition. Here it simply is that, okay, those shares are replaced by the capital account. That's one. Second is that, in order for 50CA to apply, first 45(1) itself should apply. 45(1), it's 50CA would apply only when 45(1) would apply. So, and 48 requires you to compute your capital gains. If you look into these provisions, three sets of provisions together, if there is no capital gains accruing or arising to me at all, then the position which is gradually emerging, even in Celerity's case, what was the wisdom? Wisdom behind this was that it was one of the reasons was BC Srinivasa Setty applies and no cost of acquisition is possible. But Ravish Sood in that case has also stated that, where is the consideration moving? Where is the, possibility of ever making any capital gains? So if we comprehensively look at it, I would personally believe that I should not be unduly worried about this shareholders taxation, but I fully respect what he said, and I should have otherwise also shared this with you, that it comes with a caveat. So you will have to work on it a little more. Yes.
Sir, with respect to 4730, conversion of LLP to a company.
Yes.
I think there has been a recent Supreme Court judgment is it necessary that the LLP has to continue to exist to avail the benefit of 4713? Or is it like if I'm converting from an LLP to a company basis tax spin judgment, is it like possible to have LLP and this company coexisting? The one of the businesses of the LLP being taken over by the company and then company continuing with the business?
Right, few things. This issue is independent. It is a 13 issue, 14 issue and 13B issue also. This company getting converted to LLP is 13B issue. Now your question is that, if you read 13B and contrast it with 13 and 14, there is a sea of difference, right? In 13 and 14, what is required to be taken over is the itemized assets, tangible assets and intangible assets. This is 13 and 14. When you look at this 13B, what it requires is that, not only the business but the company must be converted. Otherwise, under LLP Act, Schedule 2 and 3, you would not be allowed to convert it. It should go with all assets and liabilities, not of a business, not of an undertaking, but the entire company's assets. So this is where it is. So therefore, in the context of 13B, if we are testing this principle, my answer to that would be sab jana padega.
But in 13, sir? 13 mein we
13 you would be, it is, I think that also, had we looked into this, there are few slides on this. And what are the proposition? That any one business can be transferred. If I am a proprietor of two concerns, one can be transferred, the other business can continue. Second proposition is it need not be a new company also. It can go to even an old company also. And still 13 and 14 would be possible. So this is how it would work.
So just
Yes.
out of the blue, one structure which is there, is it like possible to account for those assets and liabilities at fair value in the books of the company?
I would take a view provided it is matching consideration. So what is commonly done is that that the values are assigned on the basis of the valuer's report. Okay, and the sum total of that is considered as a composite consideration. If it is split, because this is not a case of just conversion. This is a case, see what happens in a demerger. There is a need that asset should be transferred at book value only. So there is no value addition possible. You can't capture values. But here, you in slum sale and other conversions, you can capture the values. That is the objective. So therefore, you would be in a position subject to the explanation in section 32, explanation in section 43.1 and explanation in section 49.1. You can otherwise capture values. No issue at all. Yes.
Last question, Rohit. Yeah.
Sir, your slide mentioned something about family arrangement.
Yes, yes.
Sir, so if family is holding shareholding in two companies,
Yes.
and pursuant to arrangement, one family keeps one
Yes.
company and the other keeps the other company.
Yes.
You said the recent amendment would not affect
Should
the
not.
should not affect
Should
the
not.
taxation
Yes,
impact.
yes, yes.
Sir, if there is one independent shareholder, an investor, who
Yes.
has to transfer pursuant to this family arrangement,
Yes.
what happens to that? Is it taxable?
He is
or-
not a part of family settlement.
No, he's part of family settlement, but he's not a part of family.
See, it's family settlement is very largely understood. It does not necessarily relate to, the persons who are joined by blood. Okay, it does not necessarily relate to people who are family, as is traditionally understood. If he is part of the scheme of family settlement, there is a possibility, a good possibility of taking a view that the transfer has taken place arising out of family settlement. The important thing is that he should not have triggered the family settlement. If that is so, maybe the view could be different. He has been forced to do it. It is forced by the family on him. He had left no, otherwise his value of shares would have lost any value at all. That's what it is.
Thank you, sir. Thank you, sir.
Right. But उसमें एक चीज आपको ध्यान रखना है. This what I have said is inter se arrangements between individuals, HUFs and right. But if it is an arrangement which involves transfer of shares by one company of the shares held by it to another company, Bombay High Court in Mota's case said, वो सब नहीं चलेगा. Companies cannot be parties to family settlement. Be clear about it, okay? Yes.
Thank you, sir, for the wonderful deliberation. I, Sumit Bihani, on behalf of EIRC of ICAI and ACI CP Study Circle, would like to propose a formal vote of thanks to Pradeep Kapasi, sir, for his wonderful deliberation. Sir has covered topics like topic of restructuring and has elaborately covered the topic considering IBC, corporate restructuring, buybacks and gifts. I would like to thank sir for the time he has spent with us, and we'll look forward for hearing more such deliberations from him. At the same time, I'd like to thank Bhaiya Mohit Bhaiya for wonderfully conducting this session, and I would request Ayush Jain ji to take over the next session from here. Thank you so much.